Very good afternoon. Welcome to today's webinar. The webinar topic is Introduction to the Blockchain Technology and Application. Welcome to Dr. Devesh C. Jinwala. Dr. Devesh Jinwala is a professor in the Computer Science and Engineering Department at NIT Surat. Dr. Jinwala has the many well-known research publication and a very strong research background. His research focus mainly is in the information security, privacy issues in a journal and resource constrained environment. So without further ado, let's start with our webinar. Welcome, Dr. Devesh Jinwala.
Yeah, thank you very much to all. And steps of blockchain clear. And so it's essential first to have an introductory talk on blockchain technology and applications, and then to sort of focus on blockchain of things, or it is something which participants also can pick up having known what are the basics of blockchain. I must make it clear that although I'm showing here these 5 topics to be covered, starting from motivation and understanding what a blockchain is, what are the blockchain components at both the high level as well as at low level. What I mean by at low level is at a data structure level. Like, in terms of data structure, one would be interested in seeing how does a blockchain appear. So that would be low level view of the blockchain. And then to talk about typical applications, research issues, perhaps I might not have time to talk about. But very importantly, I would try to at least sort of focus 1 or 2 slides on when to use blockchains, when not to use blockchains, because these days everybody keeps talking about blockchain, and specifically I've seen this in student projects when the students would be using blockchains, but when they are counter questioned on why they are using blockchains, there is no justified answer. So we need a kind of tool which tells us that I apply these metrics, and having applied these metrics, I know my requirement, the project which I am working on, actually has these characteristics which are shown by the metrics, and so I am using blockchain. That's how it should be justified. So with that, I would be concluding the presentation today. That is something which we'll see at the end. Well, the principal components, if you look at, in order to understand the need for the blockchain, if you understand the global business environment, these are some of the principal components of a typical global business scenario. You have business networks with the goal to have been connected so that we benefit from connectivity. We need to have connected customers, suppliers, banks, partners, and this would not be within one geographical region. It can cross the geographical borders also, so anywhere in the world. And anywhere in the world would also mean that the regulatory boundary will not be there. It's like, the government of India will not be able to influence the businesses or the practice of the business in US. So that's what I mean by regulatory boundary being crossed. The wealth is generated by the business, by the flow of goods and services across the business network. One of the reasons why the business is actually being done. And markets are central to this entire process, which could be public market, private market, with obvious meaning, it is as it is shown. So this diagram shows various, all these components coming in, and you could see it's a kind of, very complex mesh with multiple entities coming into the picture, starting from the the actual company, partner, branch locations, point of sale terminals or the ATMs, to its clients, and the third party services which it might be taking, and so on. So it has, this entire chain is pretty complex. It's in the form of a mesh which is connected, and therefore one of the important issue, as we'll figure out, which comes up, is the aspect of trust comes up. Particular entity on this side trust something which is done, which is sort of carried out and the services which it takes from an entity on the altogether different side. And as I said, remember, these are crossing geographical boundaries. So it crosses cultures. There is no kind of imminent trust as it used to be in conventional systems built into such mechanism. Okay, the goal while doing business would be to build value and assets. And what is an asset? Anything which is capable of being owned or being controlled and which produces a value would be an asset. So we might have assets which are tangible assets, which can be actually seen. There might be assets which are intangible, non-tangible assets. There might be assets which bear some name, or the assets which might not bear some name. The asset can be a digital asset like music. One of the most complex aspect in the issue of asset is the fact that one of the important asset which we make use of all the time is anonymous asset. That is, it doesn't have any identity, which is what is cash is. Cash doesn't have the identity. So whoever has a 500 rupees note is the owner of that particular cash. So there is no identity associated with that particular cash, which is what we call as property of anonymity. And if you go into the details, into the further depth of the applications of blockchains which have come up, or with which actually the concept of blockchain started, you would realize that it is this anonymous asset which is the major cause, which is majorly responsible for giving the idea of the blockchain. Although today the applications have crossed across the that particular digital asset, but it originally started from that. All of you have heard of perhaps Bitcoin, and the concept of blockchain started from there. In fact, blockchain and Bitcoins are two different things we should keep in mind. And but I'm trying to emphasize at the same time that it was this anonymity of the asset which basically necessitated whoever researched blockchain to give the concept of the blockchain. How do we manage the assets? That's an important aspect which comes up. When we say assets is something which helps in building value or produces value, and when we have assets which could be named or anonymous asset, the question which comes up is how do we manage it? So how do we move or transfer the ownership of the asset? And when these transactions cross a trusted boundary, obviously several questions would come up. Questions like, can we permanently store the assets globally with trust? Can we deal with those having single ownership? Can we do associated identity management? So if at all a particular cash or a particular asset moves from one entity to the other entity, can we somehow do inherent implicit identity management, which we know in case of cash it is not possible to do so, because by mistake if you drop a 500 rupee note somewhere on the road, you cannot prove that it belongs to you. There is no identity management inherently built into, which is a problem with anonymous assets. How do we easily transfer the assets, and how can we create an illusion of a single global computer? Even if assets keep moving, can we have an asset? Can we have a kind of impression that everything is under control of one particular entity? So what are the issues? The issues which come up in assets transfer or in assets management are what are shown in this diagram. We show here different parties. Party A dealing with something, party B dealing with some other business, party C dealing with some third business, party D dealing with some fourth business. With all these parties, I am showing here a kind of book-like structure, and very shortly I would sort of introduce to you what it is referred to, the book-like structure. Our common sense would tell us that it must be something which is used for noting, for recording the transactions which we do, because whenever we do some transaction, it is essential to keep note of that transaction. And all of you might have practiced it. You might have been asked by your parents or whoever, by seniors, to keep a kind of account book which will have a record of what was your income, or what was the cash given to you, and how it was spent. So that transaction record is something which is very important. And we see here that there is a kind of transaction record maintained by A, B, C, and D. They take services of the bank, they take services of the auditor, and all of them interact with each other. If you try to draw in terms of a graph, you would realize that this turns out to be a typical graph structure, which is known as a clique, where the clique number is the maximum. Every node is supposed to be connected to all the other nodes if we assume that uh, each node requires the services of all the other nodes in the network. So it's a kind of fully connected graph, complete clique of the graph, and therefore the issues which come up are of the kind which are basically coming in because of this fact, because of the fact that none of these parties, A, B, C, D, or bank or auditor, would have a kind of implicit trust on each other. Whatever A does, and he shows as the records maintained by him to B or C or D, or even to bank or to auditor, neither of any of these would believe that what you say is correct, because they would say, let me verify my own record. Let me verify what I have kept as record of the transactions which I have done with you. And unless they tally, they would not believe these two are same. In order that the tally easily later on, in order that any of these parties are not tempted to do any foul play, it is expected that all these transactions are done under the control of a trusted third party. Those of you who would have studied information security as a course, if you have studied public key cryptography as one of the method for uh, building security mechanism, you would have studied public key cryptography comes with implicit presence of a trusted third party, which would be responsible for certifying that the key which you possess for encryption is indeed your own key, because otherwise nobody would trust. In fact, this entire branch is known by the name which is appropriately going, with respect to what I'm trying to emphasize. The name is public key infrastructure and trust management. This is one area of research in information security. So what basically it means, I'm not trying to take you into public key cryptography, but the point which I'm trying to emphasize is when we talk of these kinds of environments, public key environment, producing my key and trying to expect other person to believe that it is my key only, the question where trust comes in, there would always be the need for a third party to certify that yes, I know this particular person, and whatever key he produces is a genuine key. So here the transactions which are done, the entries which have been made by, I showed earlier, these books which are shown, these are, as we'll see very shortly, these are known as the ledgers, the account book, which typically in old times we used to see in the banks. Now, in the presence of core banking, the ledgers are transferred into their database, but earlier they used to be in the form of these kinds of hard copies, what I'm showing uh, in this diagram also here. This is the typical, the ledger, the book in which all the entries would be made, the book which, the accountant keeps with all the entries of the transactions done. I'll be defining that very shortly. But the point which I'm trying to make here is that every party has their own record, and why other party should believe the record which is maintained by one party. So there is a need to have the entries validated, the entries in the ledger protected, to have historic records preserved, so that later on if there is a dispute, I must be able to trace back. It is known in computers as well as in the finance world, the IT enabled finance. This particular aspect is known as audit trail. So I must be able to produce the audit trail of all of my transactions which have been done previously, in case one transaction is considered to be questionable. If somebody raises a question on one transaction, it might have been as a result of many other transactions which have been done. And so there would be a need to produce the audit trail. And it would be very commonsensical to think that preserving all to be slow, it's going to be expensive, it's going to be prone to foul play. Somebody can alter something here or there, and then there is a dispute coming in. So, what are the issues? When I say management of assets, it's done in the way which was shown before. what are the issues? Now you should be able to very easily relate with the issues which I am showing here in blue lines at the bottom of the diagram. So it is basically inefficient because every party has to keep copy of their transactions. It is expensive because multiple copies have to be maintained. It is vulnerable. It is vulnerable to attacks because any one of the party in this kind of environment, global environment, might be tempted to sort of change some entry in the ledger and say that this is not something which I had done earlier. It can refute very easily. It can alter very easily, and there can be a kind of problem coming in. So essentially, the question which we would be raising, this kind of environment, I must also mention, requires the underlying support from a distributed database management system to store the data. Now try to apply your database knowledge and think that in database management system, if you have studied, or if you might study further, you would see that data will be of two types. One data is what is referred to as the master data, which is not going to change day to day. If I store in my database the information that there is a student studying in the fourth year having admission number some XYZ, the name ABC.def, these are what are referred to as my master data, and they are not going to change day to day. But the fact that the student would have secured some X amount of marks in the midsem exam, then in final exam there'll be some other mark, and this marks would then be updated in further. So the data could be either what are referred to as temporary nature, or they can be master data, which would be which would have enough longevity, longer nature. The distributed database would store this master data, but that master data has to be updated based on the transactions which have been done. Whenever we have a distributed database of the kind which we are talking about, it also brings into the similar kind of issues which we saw earlier. It's complex. How to provide uniform, consistent view of the database. These databases are distributed. So how does the network, or how does the mechanism which is built around shows the uniform view of the database to all the parties is not easy. Complex algorithms are required there. It's expensive, we saw earlier. How do we secure all these distributed locations? We saw that earlier. How do we preserve integrity of the data? Somebody violating the data. So how do we preserve that? How do we bring in the expertise which is required to manage and maintain this data? So a distributed DBMS always comes with its own sets of problems, which are introduced because of the way the conventional business is done. I'm now trying to introduce the concept of the ledger, which I actually showed earlier, but here I'm trying to formally define what it is. I'm saying it's the system of record for a business. Whenever a transaction occurs, it is to be entered in the form of a record. Say an employee leaves the organization today. Think of payroll application. You have in your payroll all the data about who all are the employees of the organization, their names, their specialization, the department which they belong to, their age, their address, and the basic pay, allowances which they get, and so on. All this information is there. But every month, the employee is not going to leave or going to get the increment. So what you store in the database is the permanent data. It's a record which is the permanent record. But then if an employee leaves, a transaction generates, and this transaction is to be used to update the master data. This transaction is typically entered into what is referred to as the ledger. So ledger is the system of record for a business. Without ledger, I would not be saying that I'm doing business, because I go along with my static data, stationary data which doesn't change, and then I would say that I am doing business. That's not possible, because if you are doing business, there is going to be imminent change to the data. So we need some formal mechanism by which we can maintain how to change the master data, and the ledger is that particular entity. It records the asset transfer. That's why I'm saying here, it records the asset transfer between participants. If one party gives some X amount of money to the other, there is a transfer of asset. So this transfer of asset is recorded in the ledger. If you withdraw some amount from your bank account, it would be first entered into the ledger. Okay, so businesses will have multiple ledgers for whatever business networks they are indulging in. And it is the principal book or the computer file for recording and totaling financial transactions by account type, with debits and credits in separate columns. The typical account book which we expect the accountant to write. And it would be giving you a kind of monetary balance, which is beginning monetary balance and ending monetary balance for each account. While I'm stating something about ledger, keep in mind, if at all you have had exposure to the account books, what happens in those account books or ledgers is, if at all the accountant by mistakes creates an entry, he says that 100 rupees is credited into the account of X person, and this has happened by mistake, then we should note, I am trying to emphasize this to be noted, the way it is traditionally done is, there is no way by which this entry can be deleted. There is no way by which this entry can be modified. But it is an erroneous entry. So what should be done is, a corresponding debit entry must be made. This was wrong credit entry. So a corresponding debit entry must be made so that the original status of the account is tallied. That means we want the account book or the ledger to be something which is not easy to change. That is how it is traditionally. We say that it's not easy to change. And we would see that this is a property we would expect from what we are going to discuss further. I'm showing traditional ledger. So we saw assets, we saw value, we saw the ledger, and the last aspect is the participants, transactions, and contracts. Transactions I already introduced. Participants are the members of the business network, obviously. So it could be customer, it could be supplier, it could be government, there are laws or government tax which is to be paid, or a regulatory agency, somebody who gives you the sales tax or GST number. So some agency, regulatory agency, which gives you that number. So those are the participants. They normally are in the organization, but depending upon their nature, they can be outside the organization also. And each one of them would have specific identity, specific rule. Transaction, I think I've already explained. It's the mechanism for transfer of the asset. And this could range from simple transactions to complex transactions. And third is contract. So contract is the conditions for the transaction to occur. Now, it is these contracts which are not going to be so simple in nature. Contract can be simple in some case like this. If it says Anthony pays John some money, then car would pass from John to Anthony. John is selling his car, and so we say that if Anthony pays John money, then car passes from John to Anthony. But the contract could be complex, which would say that if car won't start after it is given to Anthony, then the funds should not pass to John. Now, who will decide whether car has actually started or not? So that's why the third party. When we say that third party is imminent in the transaction, it means that the third party is somebody who can we incident which has occurred? So I'm saying this is inefficient, this is expensive, this is vulnerable. We saw that earlier. The solution which blockchain adapted, I've not talked about as of now uh, anything about blockchain, but I'm starting first with the fact that in blockchain we must be able to figure out something which is known as the shared ledger. So now ledger would not be something which is a ledger maintained by every party, but it would be kind of a shared ledger. So any entry made by any entity in this, that entry is seen by everybody. In fact, it has to be authenticated by all the other sort of parties, or maybe by the parties who are consensus. It provides method of proving that the transaction had occurred. So provenance. It provides immutability with a shared ledger. Immutability means that because it is a shared ledger, because everybody sees whatever transactions are made into the ledger, it's not possible for any of the parties to change the transaction. Ledger technology. I'm showing that in terms of the diagram which we saw earlier, wherein I had a kind of central ledger. Now I'm saying it's the ledger copy is kept in every party's office, so to say, which is shared, replicated, and permissioned. Everyone has the authority to change the transaction.
Sir is facing the little technical issue. Sir will join us soon.